Here I am back again. Another thought for the day. Got something new to say. Gonna take it off any which way you might not imagine, because the topic for today is gonna be something that's like I just learned about this about a year ago. Basically, it's about a wave pattern known as Elliot Waves, but basically applies to everything, whether it's money, whether it's nature, the list goes on and on. It's one of those universal laws, right? Kind of like the law of attraction. So getting into it, gonna be talking about Elliot waves. So like the topic of today, I said is like, does money come in waves? And I'm kind of asking a question. I mean, I've definitely, like, I believe this to an extent. My belief is this theory works sometimes, but not all the time. But that's kind of like anything in life. You know, the world is always changing, life is always changing. However, there's certain structures that, you know, come and go throughout history, certain cycles. So this, to me, is just one of them. Something that, opened my mind to investing, reading charts. That's like technical analysis charts for stocks, financial markets. That's really how I got into it, how I learned about it. So, little preview. What we're going to talk about is, the origin of Elliot waves. Pretty much like breaking down how it works, like the structure of it, how it's used in investing, how it's used in nature, and getting back to some of the controversy, like how some people think it works, some people think it doesn't work. Gonna go into that a little bit. At the end of the day, I feel like it's important to take everything with a grain of salt when it comes to information, especially, and look into it for yourself. Do some research on your own if this is something that interests you. If you want to know more, I'm gonna give you some resources. You can go and dive a little deeper into it. And yeah, hopefully you find some value, some benefit out of this. My own personal experience with Elliott Waves started out when I started trading. I was really just, consuming all the information about investing and trading as I could. And, after I got kind of like the basics down, I came across a trader who used the Elliott Waves, and that was like the main tool that he used. And tools in trading, different, like Elliott Waves would be one. A lot of different tools you can use. And at the end of the day, the goal is to be able to use as few tools as possible. Usually a lot of people, when they start trading, when they start investing, they kind of get into all the tools and they use a bunch of tools. And that's good because it's important to know how they all work. But the more you use, the more confusing things get. And that's why it's best to, find out, develop your own style, see what works best for you. And just go off of that. Whatever you feel fits your personality the best. If that's Elliott Waves, then use Elliott Waves. So yeah, a trader who I started following at the beginning used basically only Elliott Waves. And he had a live channel on YouTube actually, and that got taken down. I'm not sure why. So I was exposed to this trader for about a month, saw what he was doing, and I saw how it wasn't perfect. He had to adjust it over time, but for the most part, like, it worked. I feel like more than 50% of the time. So this man personally made a lot of money trading using just Elliott Waves. I use Elliott Waves now to some extent. I don't go to the extent that he did, where he like drew them out, used different like measuring levels, stuff like that. But when I see them, like, I can look at a chart now and I can notice something that looks like it's like a perfect Elliott wave. And if I see that, then I'll usually apply that to what I'm doing, and I'll usually trade off of that, buy off of that, sell off of that, whatever. But yeah, when I see it and it's clear to me, then I'll use it. So that's pretty much like how I go about using Elliot Waves, how I learned about Elliot Waves. And shortly after that, interesting thing, I was just looking at like random books at the bookstore, and I discovered this book about like patterns in nature. And I realized that basically like this book was explaining how certain patterns in nature were made using this Elliott wave principle. I'm going to get into that. So yeah, just a quick preview again. Going to go into Elliott waves, how it started, how it works in investing, how it works in nature, some of the other tools it's used with, and just some of the controversy around it, some of the things you want to be careful of when you're using it. So getting into it, Elliott waves started, at least as far as Western history is written, Elliott waves were first started by a man named Ralph Nelson Elliott, and this was an accountant who also, invested. And he discovered after studying like charts and numbers and all that kind of stuff that price action generally moved in waves. And this man discovered this in about 1930. And he wrote his first book on it called the Wave Principle book, which is still on sale today in 1938. And this is, kind of like him introducing his theory to the world, really. And as far as I understand, this was definitely known throughout history in ancient times, but obviously it just wasn't referred to as Elliott waves back then. As far as modern Western history understands it, it was a different theory that kind of resembles this. So basically, it focuses on investor psychology and crowd psychology, because basically there's other books you can get into on that, and I'd like to do another video on that too. But if you look at when a crowd invests in something, there's certain elements that take place, certain structures that seem to happen. For example, one way that it's put is like so if there's like this is a real life true example. There was like a county fair in America, and there was like a contest where you had to guess how much a pig weighed, something like that. Basically, like everybody made their guess on how much this pig weighed. Nobody got it right, but when the average of all these guesses were taken, it was closer than any one person guessed that it would be to the actual weight, which is very interesting. And this kind of concept applies to the economy and money, really. So yeah, that's another thing for another day. Just wanted to let you guys know that it had something to do with Elliott waves. And again, what I'm talking about is investor psychology, otherwise known as crowd psychology. So I'm going to get into kind of like how Elliott waves work and the structure of them. And basically, it's a wave of 5. So it's numbered first 1 to 5 and then ABC. And it has a different structure for price movement going up and a different structure for price moving going down. However, these structures are both the same. So for example, it's going to be first, and it would help too if you guys want to check out, just Google Elliott waves and you'll see a chart that's like pretty clearly what I'm explaining. So basically, it goes up, the first wave goes up, second wave goes down a little bit, so it doesn't go down more than the first wave went up. Third wave goes up, and this is generally the like biggest move up out of the cycle. Fourth wave goes down a little bit, usually to the same extent the second wave went down, which of course would be less than the third wave went up. And then the fifth and final wave goes up again. So then there's like a slight correction, or a slight, like going down, and then this is the ABC. So then it goes down, the fifth wave goes down approximately the same height that the fifth wave went up, which is the A, and then B goes up. Of course, just like before, it goes up a little bit, doesn't go up as much as the A wave went down. And then the C wave goes down approximately the same amount as the A wave. And then, yeah, if this were to continue to go up, it would just repeat this cycle over. So then, like, the bigger wave obviously is going up in an uptrend, going down, and then the smaller wave, the ABC, is going down, kind of like the correction. So if you're looking at, buying into anything, like investing in anything, you want to take a look at the chart, see if you notice anything like this going on. And this applies to like micro and macro levels. So you would see this, like, if you took a chart of something and you looked at it over like say like 100-year span, you might see, the bigger picture. You're gonna see like an Elliot wave formation. Now you break down, say like that 100-year span goes into like 3 cycles of Elliot waves. Now you take one of these cycles of Elliot waves and you break it down, so that it might be like a 25-year period, and you're gonna see like 3 more cycles of Elliot waves. So this basically can go down, to such a macro level to where you can't even really see it anymore. I understand this is kind of confusing. However, doing my best to explain it, and it would help a lot just check out a chart on Google. So there's certain cycle names that are given. Basically, like a grand super cycle would be like the macro level, the biggest macro level, that's like multi-century, and it goes down to like super cycle, multi-decade, 40 to 70 years, all the way down to sub-minute, which could be Elliot waves on a minute level, like minute by minute. And just kind of getting into Elliot waves a little bit more. The first wave usually starts when people least expect it. So when when price is first starting to go up, generally the overall attitude of the market is that things are still negative. People don't really think that the price is going to go up yet. They think it's still going down, and which makes this first wave not really noticeable until maybe like the third or fourth or fifth wave has really formed to where you can understand that the first wave has happened. So the second wave, goes down a little bit, corrects on the first one, which generally happens anytime a price shoots up. Like the higher a price shoots up, usually the more it's going to correct. The quicker it goes up, quicker it goes down. What goes up must come down, as all things in life. So as the crowd, starts to see that things are going up, they're still, kind of in a mindset where, just things aren't looking good still. This is just a quick positive upswing. So people usually like sell out a little bit, and that usually is what causes the second wave to go down a little bit. And then once the third wave starts, people start to realize that, okay, things have changed, like things have turned around, prices have started gone up, and about halfway through the third wave is really when people start to notice that like an Elliot wave is forming. So this explains why the third wave is usually the longest, because the third wave is when most people usually buy in, start to like invest, and this just drives the price up even more. Everyone starts to realize the Elliot wave is happening. So wave 4, pretty much the same thing as the second wave, and it doesn't have to really go straight down. It can even go sideways for a while. Wave 5 is the final leg up for the first wave. It usually is when the attitudes of a market change. when everyone starts to realize, okay, you know, this thing's like turning around, prices going back up, economy's getting better, whatever it is. That's when people really, like, on a mainstream level, really start to like realize this, and people like feel comfortable, you know, telling people that, you know, good times are ahead. However, at the same time, you know, most of the people have already bought in, invested back in, so it's not usually going to be as big as a upswing as the second wave. And a lot of people that do get in on the fifth wave are usually like referred to as like amateurs still learning. FOMO, fear of missing out, because, you know, after, you don't really want to get in on that fifth wave, because there's going to be a bigger, you know, wave ABC correction that's going to happen after that fifth wave. And these corrections, you know, these Elliot waves are like I'm saying, like, you know, once the third wave goes around, it's kind of transparent as to what's going on. But when things correct and the ABC waves come along, those are harder to recognize. And this is where a lot of people get burnt trying to trade or invest into these ABC wave corrections. So another thing to look into is called Fibonacci levels, and these are also used with Elliot waves. Fibonacci levels are basically like percentages that are used to kind of like guess how much something's going to go up or down in relation to what it's already done. And just like, you know, just like Elliot waves, just like everything else, like these work some of the time, not all the time, but a lot of people use them. And just being at that, like, the more people that understand this, the more people that recognize this, are the more people that are going to use these levels. And it kind of, you know, shapes price action, prices, the economy, just based on the fact that so many people recognize this and are buying and selling based off of these levels. So, you know, this all just kind of goes into how understanding all of this, even if you're not using it, just simply understanding this will give you a advantage when it comes to investing and making money, understanding the economy, all that stuff. So Fibonacci levels are based on something called the golden ratio. The golden ratio is basically like 1.618, and this, I'm not really going to get into this right now, but it's basically used as like fractions and percentages, and you can look at certain levels where a price is most likely to go using this. So covered investing, and it helps to really understand this, like how it applies to everything, is that Elliot waves are also seen in nature. Like I was saying, I found a book on this, and this is actually the man who introduced this concept and wrote the first book on it. Well, his second book is called Nature's Laws: The Secret of the Universe. He wrote this in 1946, and he basically compared like the more he researched these Elliot waves and this principle, the more he recognized it throughout the rest of the world, which leads me to believe that this was a concept that, you know, ancient people in ancient times understood. They just obviously didn't call it Elliot waves, and for whatever reason, you know, history gets changed through time, history gets lost, books get misunderstood, misinterpreted, all that kind of stuff. So what he first realized was that the construction of the Great Pyramids in Egypt had a very similar structure to the way Elliot waves work, as far as like their measurements and stuff like that. Like whoever designed these things seemed like they must have some idea of the Elliot wave principle. And he went on to recognize that this is also in nature, as he saw that the spiral shapes in a sunflower, like the way a sunflower naturally spiraled out as it grew, the measurements of this were also very similar to the way Elliot waves work. And also the thing that I really noticed when I saw it, when this was explained to me, that it made the most sense to me, was like a seashell. So if you look at the structure of a seashell, the way it spirals out, uh, the ratio that it kind of spirals out at, and the levels are very similar to Elliot Wave principle. And I was pretty man, I was just kind of like in awe when I saw this. I was like, whoa, this actually, like, there's something to this. Like, this is definitely something that I would like to learn more about, and that's really what the main thing that got me more and more interested into it. And the last thing that people say is like Pythagorean Theorem, which is like a Greek mathematical equation, was or not was, but is or does use the Elliot wave structure in the theorem. Also the Fibonacci retracement level structure. So, with anything, doesn't work every time. However, it does work some of the time. So how do you even really use it? Especially when there's so many people who say that, this is just basically, it's bull. Like, so many people think that it's just like this guy made this up and he was crazy and he had no idea what he was talking about. Some of these people have, written articles, and this is more of like a recent thing, and to me it seems like these were people who tried to use this for their trading and their investing and they got burnt on it. So then they, all of a sudden they just like went and hated on it, like, yeah, this never works and all this stuff like that, and it just didn't work for them because it doesn't fit their trading style, their investing style, their personality. But that doesn't mean that it doesn't exist. So yeah, you can check out some of these articles if you like. Check out even a book where book was written in 1938 called The Wave Principle. And there's a lot of that was the Elliot, his first book, and there's a lot of people that basically try to find fault in that book, which I'm sure you can, depending on how you look at it. There's also some like higher level people in higher up banking positions that go out of their way to try to warn people not to use this. So it's important to understand like both sides of this. And yeah, that's pretty much all I'm gonna get into right now with this. Be interesting to know how interested people are about this. Is this something that you want to know more about? Do you want to know more about other accompanying theories that fit with Elliot wave principle, like Fibonacci charts, stuff like that, or Fibonacci retracement levels? So yeah, I mean, there's a lot to this. Like, it's very interesting to me. Go ahead and smash up the likes if you thought this was interesting as well. Go ahead and leave any comments or questions if you like. Go ahead and subscribe if you'd like to hear more. Got the link up for the email address in the Discord group. Should have those up pretty soon. Have a good day.